Welcome to the fourth video related to assets in the accounting module. In the previous videos, we have been exploring how assets move from an asset to an expense. We looked at a current asset, inventory, in the last video. In this video, we will expand on the concept using an example with a long-term asset, specifically a building. When we buy a building or incur the initial cost for a building, we decide whether to record that cost as an asset or as an expense. In order to answer the question of whether we should record the purchase of a building as an asset or an expense, we need to ask ourselves, is the cost incurred benefiting our company in the future or in this period? We talked about this briefly in the first video where we started thinking about the future versus the current period. If you remember back, the reason we gave for recording a building as an asset when we first purchase it is that we plan to use the building for many years to come to generate revenue. Each year we use the building to generate a little bit of revenue. In accounting, we want to record expenses in the same period that they help us generate revenue. So with a building, we're going to expense a small portion of that building every month. We call that expense depreciation expense. When we record depreciation expense, we reduce the asset account and increase expenses. Increasing expenses decreases net income. Let's look at a specific example for a building we might purchase. Let's assume we bought a building for $400,000 and plan to use it for 40 years. Initially in year one, we want to put the $400,000 in a building account, which is an asset. We may also decrease assets by $400,000 if we pay cash for the building, or later we'll look at we might actually increase liabilities if we finance the building, if we get a mortgage for the building and we're going to pay it off later. Again, we'll get to that part in a little while. Right now, I just want you to see that the building is going to go into an asset account. And let's assume that we want to use that building for 40 years. We can divide that $400,000 by 40 and get $10,000 of depreciation expense per year. In a real example, we would likely record depreciation monthly or at least quarterly instead of annually like I'm doing here. We might also use a more complicated depreciation method or record depreciation for a partial year. You'll learn about all of those nuances in your accounting course. For now, just dividing by the number of years you plan to use the asset is sufficient to drive home the points that I want you to remember. Now, I also want you to know that the $10,000 is going to an expense. That expense will be recorded at the end of year one. So the $400,000 is recorded at the beginning of year one when we purchase the asset on January 1st. And the expense is recorded at the end of the year. Let's look at a few more details around what that expense does. First, that expense is going to reduce net income because anytime we add to an expense, see how we're subtracting those expenses here from revenue. Anytime we increase the expense, we're going to decrease net income. So adding to that expense is going to actually decrease net income. Also, recording depreciation is going to decrease the asset account. So that $10,000 is coming out of the asset account and moving over to an expense. So at the end of year one, what we call the book value in the asset account is going to be $390,000, not the original $400,000. In a later video, we'll add some more detail to this. The $10,000, for example, doesn't directly come out of the asset account. We book that through what's called accumulated depreciation, but we'll get to that in a future video. For now, again, I just want you to understand that that $10,000 is moving from the asset account and into an expense account, and booking that expense is going to reduce net income. So I know we covered a lot in this video, and we're going to continue to add to these concepts. So the main things I want you to remember now about long-term assets like a building are that depreciation moves the cost of the building from an asset account to an expense account over time. It's just a little bit every year or every month is going to be moved over into that expense account. Depreciation is an expense, so it reduces net income. And finally, depreciation reduces the asset account each period. So again, the concept is just that first line. Depreciation moves the cost of the building from an asset account to an expense account a little bit at a time. That's all we need to cover right now related to depreciation expense. In the next videos, we're going to move on to liabilities and look at several liability accounts before we think about the balance sheet in total.